Ladies and gentlemen, there is a number that most investors have never heard of. And right now, that number is moving in a way it has not moved in decades. It sits quietly on a warehouse report published by an exchange in New York, updated every single trading day, read by almost nobody outside, a small circle of bullion dealers, hedge fund analysts, and central bank watchers. That number is the registered silver inventory on the Comex exchange. And over the last several years, it has fallen from close to 200 million ounces down to a fraction of that. Some of what you will read online about this number is exaggerated. Some of it is outright wrong. But underneath the noise, something real is happening. And understanding it requires us to step back much further than silver itself. We need to talk about debt. We need to talk about the Federal Reserve. We need to talk about human psychology under uncertainty. And by the end of this video, you will understand why a shrinking pile of metal in a handful of vaults in Manhattan and Delaware is connected to decisions being made in Washington, in Beijing, in Frankfurt, and in the mind of every single investor who has ever felt that quiet, nagging fear that their money might not be worth what they think it is. Before we go further, I want to ask you something. Type in the comments where you are watching this from and tell me honestly right now, are you holding gold? Are you holding silver? Or are you sitting mostly in cash, I asked, because the answer tends to say more about how you are feeling about the economy than almost any survey could. Write it down. We will come back to why that matters. Let's start with the part almost nobody explains clearly, which is what money actually is and why that question has become urgent again after being ignored for most of the last 40 years. Money at its core is not the paper or the digits in your bank account. Money is a claim on future goods and services, and its value depends entirely on trust. Trust that the issuer will not print too much of it. Trust that it will still buy roughly the same basket of bread, fuel, and shelter next year as it does today. For most of modern history, that trust was anchored to something physical, first gold, then a hybrid system where the dollar was loosely tied to gold and every other currency was tied to the dollar. That system ended in 1971 when the United States severed the last formal link between the dollar and gold. From that moment forward, every major currency on earth became what economists call a fiat currency, meaning its value rests entirely on confidence in the government and central bank that issue it, not on any physical backing at all. For a long time, that system worked reasonably well because central banks and the Federal Reserve in particular generally kept the growth of money supply in a range that didn't destroy purchasing power too quickly. But something changed after 2000. The global financial crisis forced the Federal Reserve to cut interest rates to near zero and begin a policy called quantitative easing, which is simply the central bank creating new reserves to buy government bonds and other assets, pushing money into the financial system in an attempt to prevent a total collapse of credit. It worked in the sense that the crisis was contained, but it also established a pattern. Every time the economy hit trouble, the response was the same. Lower rates, buy bonds, expand the balance sheet, flood the system with liquidity. This happened again on a much larger scale in 2020 when the pandemic forced governments to shut down entire economies and central banks responded with the largest coordinated monetary expansion in history. Trillions of dollars were created in a matter of months, and that is the part of the story that connects directly to what we are seeing in silver today. Here is the mechanism explained simply. When a central bank expands the money supply faster than the real economy grows, more currency is chasing the same amount of goods, services, and hard assets. Eventually, that shows up as inflation. We saw this play out openly in 2021 and 2022 when consumer prices in the United States rose at rates not seen since the early 19. The Federal Reserve responded the only way it knows how, by raising interest rates aggressively, which is designed to cool demand, slow borrowing, and bring inflation back toward its target. But here is the tension that very few people talk about openly. The United States government, along with most developed nations, is now carrying debt loads so large that higher interest rates create a second problem even as they solve the first. Every percentage point increase in rates means billions. And in the case of the U.S. federal government, hundreds of billions of dollars in additional interest payments every year simply to service existing debt. This creates what economists call a debt trap. Rates need to stay high enough to control inflation, but not so high that interest payments on government debt become unsustainable and crowd out everything else in the budget. It is an extraordinarily delicate balancing act. And history tells us that when governments face this exact tension between fighting inflation and protecting their own sovereignty, they eventually choose to let inflation run a little hotter because default is politically unthinkable. And inflation is, in a sense, a quiet, slow motion default that spreads the pain across everyone holding the currency rather than concentrating it on bondholders. This is not speculation about what might happen. This is a pattern that is repeated across history in ancient Rome and Weimar Germany, in dozens of Latin American economies through the 20th century, and in a milder but still meaningful form in the United States and Europe over the last several years, when governments cannot grow their way out of debt and cannot politically survive austerity. They lean gradually and often without ever saying so directly on currency debasement. And this is precisely why gold and silver have re-entered the conversation among serious investors, central bankers, and sovereign wealth funds after being largely dismissed as relics for the better part of 2 generations. Gold has always played a unique role in the global financial system. Even after it was formally removed from the currency system in central banks around the world, never stopped holding it. It sits on their balance sheets as a reserve asset precisely because, unlike a bond or a currency, it carries no counterparty risk. When you hold a U.S. Treasury bond, you are trusting that the United States government will honor that obligation. When you hold gold, you are trusting nothing except the physical properties of the metal itself. That is why since 2022, we have watched central banks around the world, particularly in China, India, Russia, Turkey, and several other emerging economies, accumulate gold at a pace not seen in decades. This has been extensively documented by the World Gold Council and by the central banks themselves in their own reporting. The reasoning behind this buying is rarely stated explicitly in public, but the economic logic is not hard to follow. Nations that are wary of relying too heavily on the US dollar as their primary reserve asset, especially after seeing how quickly financial sanctions can freeze a country's access to dollar-denominated reserves, have strong incentives to diversify into an asset that cannot be frozen, cannot be sanctioned, and cannot be printed into oblivion. Silver sits in an unusual position relative to gold. And this is the part of the story that brings us back to that Comex inventory number. Silver is not just a monetary metal, it is also a heavily used industrial metal essential to solar panel production, electronics, medical devices, and a growing list of green energy technologies. This dual identity means silver demand comes from 2 very different sources at once: investors seeking a store of value and manufacturers who simply need the physical metal to build things. For years, industrial demand for silver has been climbing steadily, driven in large part by the global build-out of solar energy infrastructure, while mine production has struggled to keep pace because most silver is actually produced as a byproduct of mining for other metals like copper, lead, and zinc, meaning supply doesn't respond quickly, even when prices rise. When you combine steady industrial consumption with renewed investment demand during a period when investors are worried about currency debasement, you get sustained pressure on available above-ground supply. And that pressure shows up most visibly in exactly the kind of warehouse data we mentioned at the start of this video. Now, I want to be careful and precise here because this is exactly the kind of topic where sensationalism creeps in and does real damage to people's understanding. Comps Warehouse Silver is reported in 2 categories: registered and eligible. Registered silver is metal that has been formally committed for delivery against futures contracts, meaning it is immediately available if a contract holder demands physical delivery. Eligible silver meets the exchange's quality standards, but is simply sitting in storage, often owned by private parties, exchange-rated funds, or institutions who have no current intention of delivering it. Over the past several years, registered inventories have declined substantially from their peak levels around 2021, a trend that has been documented across multiple independent data sources tracking CME Group's own published figures. At the same time, it's worth noting that some claims circulating online about the exact size of this decline have been disputed, with certain viral figures turning out to be inaccurate or exaggerated when checked against the exchange's actual reporting. This matters because the responsible way to think about this story is not to chase the most dramatic number you can find, but to understand the underlying trend, which is real: a persistent multi-year decline in the portion of silver immediately available for delivery, even as open interest in silver futures, meaning the total volume of paper contracts outstanding, remains many multiples larger than the physical metal sitting in the vaults. This is not by itself evidence of an imminent default or a broken market. The vast majority of futures contracts are settled financially and never result in anyone actually demanding physical delivery, which is exactly how these markets are designed to function. But the trend still tells us something important about underlying physical demand. And it echoes a dynamic we've seen before in market history. In 1980, silver prices spiked to extraordinary levels, driven in part by the Hunt brothers' attempt to corner the physical silver market. An episode that ended in dramatic fashion when exchange rules were changed and prices collapsed just as quickly as they had risen. That episode is often misremembered simply as a story of manipulation. But the deeper lesson from 1980 is about what happens when paper claims on a commodity vastly exceed the available physical supply during a period of genuine monetary anxiety. Because 1980 was also the peak of a brutal inflationary decade when investors around the world were losing faith in the ability of the dollar to hold its value. We are not in an identical situation today. Market structure, regulation, and the composition of participants are all different now. But the underlying human behavior seeking a physical store of value during a period of monetary uncertainty is a constant across every era because it is rooted not in economics, but in psychology. This is a good moment to talk about what is actually happening inside the human brain during periods like this. Because understanding the biology of fear and greed will help you understand market behavior far better than any spreadsheet. When investors perceive a threat to their financial security, the amygdala, the brain's threat detection center, activates in much the same way it would in response to a physical danger. This triggers a cascade of stress hormones, primarily cortisol, which narrows attention, heightens emotional reactivity, and pushes people toward fast, instinctive decisions rather than slow, deliberate reasoning. This is precisely why markets during periods of fear tend to move in sharp, exaggerated swings, because large numbers of people are simultaneously experiencing the same biological stress response and reacting to it in similar ways, selling what feels unsafe and buying what feels protective, often without fully articulating why. On the other side of that coin sits greed, which operates through a different neurological pathway centered on dopamine, the brain's reward anticipation chemical. When an asset is rising rapidly, dopamine release creates a powerful anticipatory pleasure, not from having already profited, but from imagining future profit, which is why speculative rallies so often overshoot rational valuations and why so many investors buy near the top, driven by a neurochemical response rather than a considered judgment about value. Understanding this doesn't make you immune to it. Nobody is fully immune to it. But recognizing that your urge to panic sell during a downturn or chase a rally during a spike is in part a biological reflex rather than a rational calculation is one of the most valuable pieces of self-knowledge an investor can develop. Let me tell you about someone who learned this lesson the hard way and someone else who learned it early enough to benefit from it. These are illustrative stories, not real individuals, but they reflect patterns I have seen repeat across real market cycles for decades. Consider a man we'll call David, 46 years old, an engineer in Ohio, who had spent nearly 2 decades building a retirement portfolio, mostly in index funds, with a small allocation to bonds he considered his safety net. In early 2022, as inflation numbers began climbing and headlines grew increasingly alarming, David felt that familiar tightening in his chest every time he opened his brokerage app. He watched the value of his bond holdings decline as interest rates rose, watched his equities wobble, and felt for the first time in his investing life genuinely unsafe. Acting on that fear, he liquidated a significant portion of his portfolio near the bottom of a sharp correction and moved almost entirely into cash, telling himself he would wait for things to calm down before getting back in. 2 years later, inflation had eroded the purchasing power of that cash meaningfully, while the market had recovered and moved well beyond where he had sold. David didn't lose his money in the traditional sense. He lost it slowly, invisibly, through the quiet erosion of what that cash could actually buy, and through the opportunity cost of sitting out a recovery driven by fear rather than analysis. His mistake wasn't holding cash. Cash has a role in every portfolio. His mistake was making a permanent, emotionally driven decision in response to a temporary, fear-driven moment. Now consider a woman we'll call Priya, 31 years old, working in healthcare administration in Texas, who began paying attention to monetary policy almost by accident after a conversation with her father about how differently his retirement had been shaped by the inflation of the late 1970s compared to the relatively calm decades that followed. Priya didn't panic, and she didn't chase headlines. Instead, she spent several months quietly educating herself on how central banks operate, how debt cycles unfold, and how different asset classes have historically behaved during periods of currency debasement. She made a deliberate, unemotional decision to allocate a modest percentage of her long-term portfolio, something in the range that many financial advisors discuss as a reasonable diversification allocation into physical gold and silver, treating it not as a speculative bet, but as a form of insurance against a specific, well-documented historical risk. She didn't try to time the market. She didn't buy based on a dramatic headline. She simply built a position gradually over time as part of a broader strategy that also included equities, real estate, and cash reserves. Several years later, her portfolio wasn't spectacular, but it was resilient because it had been built to withstand multiple different economic environments rather than optimized for a single outcome she was hoping would happen. Before we go further, if you're finding this useful, take a moment to like this video and subscribe, because what we're about to cover ties directly back to everything we've discussed so far. And the final insight of this video only makes sense once you understand the full picture we're building here. Stay with me, because this next section is where all of these threads, the Fed, the debt cycle, central bank, gold buying, and the psychology of fear and greed come together into something much bigger than silver itself. Let's talk about currency strength, because this is the piece that connects domestic monetary policy to global capital flows and ultimately to precious metals. The value of any currency on the international stage is a relative measure, meaning the dollar's strength or weakness is always expressed in comparison to other currencies, not in isolation. When the Federal Reserve raises interest rates relative to other central banks, it tends to attract global capital into dollar-denominated assets because investors can earn a higher yield holding dollars than holding euros, yen, or other currencies. This capital inflow strengthens the dollar. But when the Fed is forced to cut rates, whether to support a slowing economy or to manage the burden of financing enormous government debt, that yield advantage shrinks and capital can flow elsewhere, weakening the currency. A weaker dollar has a very direct relationship with gold and silver prices because both metals are priced globally in dollars. When the dollar weakens, it takes more dollars to buy the same ounce of gold or silver, which shows up as a rising price, even if nothing about underlying supply and demand for the metal itself has changed. This is why so many analysts watch the relationship between Fed policy, the dollar index, and precious metals as a single interconnected system rather than three separate stories. Layer geopolitics on top of this, and the picture becomes even clearer. Over the past several years, we have watched a gradual but unmistakable shift in how a number of major economies approach reserve diversification. Sanctions imposed on Russia's central bank reserves following its invasion of Ukraine sent an unmistakable signal to every other nation holding large dollar reserves that those reserves, however large, exist at the discretion of the country that issues the currency and controls the financial infrastructure they move through. That is not a criticism of the sanctions themselves, which were a policy response to a specific geopolitical crisis, but it is an observation about the economic lesson every finance ministry around the world absorbed from watching it happen. Nations that might, for any number of political or economic reasons, someday find themselves at odds with Washington, have a rational incentive to hold a portion of their reserves in an asset that cannot be frozen by executive order. This is a significant part of why central bank gold buying has remained elevated for several consecutive years, a trend documented consistently in World Gold Council reporting, and it represents official sector demand operating on a completely different timescale and motivation than retail investor sentiment. Central banks are not buying gold because they expect a quick trade. They are buying it as a multi-dead hedge against a shifting geopolitical and monetary order. This is where we can finally draw the historical parallels together properly. In the 1970s, the United States faced a combination of persistent inflation, a weakening dollar following the end of the gold standard, and a series of geopolitical shocks, including the oil embargo that shook confidence in the existing monetary order. Gold, which had been fixed at $35 an ounce for decades, was revalued by the market to several hundred an ounce within a few years once it was allowed to float freely, and silver moved dramatically as well, eventually reaching the extraordinary highs of 1980 before the Hunt brothers' position collapsed. In 2008, we saw a different kind of crisis, a credit and banking collapse, driven by excessive leverage in the housing and financial system, met with unprecedented monetary intervention, which set the stage for a multi-year rise in gold prices as investors sought protection from what they correctly anticipated would be years of near zero interest rates and expanding central bank balance sheets. In 2020, we saw yet another variation. A pandemic-driven collapse met with the largest and fastest monetary and fiscal expansion in history, which planted the seeds for the inflationary surge that followed in 2021. In 20, each of these episodes was different in its specific trigger, but each one shared a common thread. A moment of acute stress forced central banks and governments to choose between short-term stability and long-term currency integrity. And in each case, the response leaned towards stability now and inflation later. Precious metals, again and again across these episodes, have served as the asset class that responds most directly to the erosion of confidence that follows. I want to be very clear about something because responsible analysis requires it. None of this means silver or gold prices are guaranteed to rise from here, and anyone who tells you a specific price target with total confidence is selling you certainty that does not exist in financial markets. What we can say based on historical pattern and current economic structure is that several of the conditions that have historically preceded meaningful moves in precious metals are present simultaneously today. Elevated government debt relative to the size of the economy, a central bank managing a difficult balance between inflation control and debt servicing costs, sustained central bank gold buying at a historically unusual pace, persistent geopolitical tension around the dominance of the dollar and global reserves in a physical silver market where industrial demand continues to grow against a supply base that responds slowly. These are not predictions. They are observations about the current landscape and how that landscape compares to prior periods when precious metals played a significant role in investor portfolios.